When we talk about revolutionary companies that have redefined industries and reshaped our perception of technology, energy, and mobility, Tesla inevitably tops the list. Founded in 2003, Tesla Incorporated, TSLA, has grown from a niche electric vehicle startup into a dominant force in the global automotive, energy storage, and clean energy markets. Under the leadership of Elon Musk, the company has pursued bold ambitions, producing electric vehicles, EVs, at scale, pioneering autonomous driving technologies, and even launching into the solar and battery storage business. For many investors, Tesla is more than just a company, it's a movement. But the question remains, should you invest in Tesla stock today? Let's take a deep dive into Tesla's performance, financials, valuation, and growth potential to better understand whether TSLA deserves a place in your portfolio. Earnings per share, EPS. Tesla's EPS is a good starting point. Over the past few years, Tesla has transformed from a company bleeding cash to one consistently delivering profits. As of the latest financial reports, Tesla's EPS stands at approximately $3.35. This shift from negative to positive EPS illustrates its transition into a more mature, financially stable enterprise. Price-to-earnings ratio, PE. Tesla's PE ratio has been a topic of intense debate. Historically, it has traded at astronomical multiples, north of 300 at times, because of investor expectations around future growth. Currently, the PE ratio has cooled to around 70 to 90, still high by traditional standards, but arguably justifiable for a company with Tesla's innovative edge and market potential. Revenue. Tesla's revenue growth is staggering. In 2020, the company earned about $31.5 billion. That jumped to $53.8 billion in 2021 and surged to over $81.5 billion by 2023. Each quarter, the company continues to post impressive revenue figures, driven by increasing vehicle deliveries, expanded manufacturing capacity, and new energy product sales. Net income. Tesla's net income reached approximately $12.5 billion in 2023. This marked a significant increase from prior years and reflects improved operational efficiency, cost controls, and economies of scale in vehicle production. Consistent profitability is no longer a dream, it's a recurring reality. Dividend yield. Unlike many mature companies, Tesla does not currently offer a dividend. The company reinvests its profits into expansion, R&D, and infrastructure. While this might turn off dividend-focused investors, growth investors typically see this as a positive. Tesla is focusing on the future. Debt-to-equity ratio. Tesla's debt levels have been a concern in the past, especially during its years of cash burn. But the company has dramatically improved its balance sheet. Its debt-to-equity ratio currently sits at around 0.13, reflecting low financial leverage and a strong equity base. In short, Tesla is not reliant on debt to fuel its growth. Current ratio. Tesla's current ratio is approximately 1.7. This indicates that the company has more than enough short-term assets to cover its liabilities, signifying solid liquidity and a healthy working capital position. Free cash flow, FCF. Free cash flow is perhaps one of the most telling indicators of Tesla's financial stability. In 2023, Tesla posted over $9 billion in free cash flow. This gives the company ample flexibility to reinvest, expand, innovate, or weather downturns without taking on additional debt. Revenue growth. Tesla's compound annual revenue growth rate over the last 5 years is impressive, well above 40%. The company has expanded its production capacity significantly, with gigafactories in Nevada, Shanghai, Berlin, and Texas. Each factory unlocks new market opportunities and efficiencies. Earnings growth. Tesla's earnings growth has been equally remarkable. From a net loss of nearly $2 billion in 2017 to net income of $12.5 billion in 2023, the transformation is astounding. This isn't just growth, it's hypergrowth. Market cap. Tesla's market capitalization has fluctuated due to stock price volatility, but it hovers around $700 to $900 billion. At its peak, it briefly crossed the $1 trillion threshold. Tesla remains one of the most valuable automakers in the world, and one of the most valuable companies, period. Price-to-book ratio, PB. Tesla's PB ratio is high, often exceeding 10x. This is typical for high-growth tech companies. Critics might say this implies overvaluation, but proponents argue it reflects Tesla's intangible assets, brand, IP, AI leadership, and autonomous software. PEG ratio, price/earnings to growth. The PEG ratio, which adjusts the PE based on expected growth, hovers near 1.5 to 2 for Tesla. A PEG of 1 is considered fair value. While Tesla's PEG is above that, its rapid growth potential may still make it attractive. Beta: Tesla has a beta around 2. This means its stock is about twice as volatile as the market. For risk-tolerant investors, that volatility may be acceptable, especially if they believe in the long-term story. 52-week high/low: over the last year, Tesla's stock has ranged from about $152 to $299. This wide range illustrates the roller coaster ride of investing in Tesla, but also the potential for strong returns. Tesla isn't just an auto manufacturer. It's a technology company, a clean energy pioneer, a robotics innovator, and a software powerhouse. Its vehicles are packed with hardware designed for full self-driving. Its Dojo AI chips, custom designed for machine learning, are game changers. The Tesla Energy division aims to transform how we generate, store, and consume energy. That said, Tesla stock isn't for the faint-hearted. The valuation is high. Volatility is high. But so is the potential upside. For long-term investors who believe in Elon Musk's vision, in the shift to electrification, and in the integration of software with transportation, Tesla may be one of the most compelling stories of our time. Would I personally invest in Tesla? Yes, though cautiously, and as part of a diversified portfolio. I believe Tesla has what it takes to remain an innovation leader for the next decade. But I also acknowledge that the road ahead is not without bumps. For investors evaluating Tesla today, consider your risk tolerance. Are you comfortable with high volatility for the chance of high reward? Can you hold through downturns? Are you aligned with the long-term mission? If yes, then TSLA might deserve a closer look. As always, do your own research, consult with a financial advisor, and never invest more than you can afford to lose. But for those who believe in disruptive innovation and want exposure to the future of mobility and energy, Tesla is one ride worth considering.